So welcome to today's event, at which we will discuss the latest Reform Scotland's report, Taxing Times, Why Scotland Needs New, More and Better Taxes, which is an examination of how Scotland's tax system might be made more fit for purpose in this third decade of the 21st century. And we're delighted to be joined by the paper's author, Heather McCauley, who is all the way from Wellington in New Zealand, where I believe it's currently 9 p.m. Is that right, Heather?
That's right. And very dark.
You're missing prime time TV for us. We're very grateful. So Heather, as many of you will know, is a public policy expert and a former senior civil servant who has worked for the New Zealand and Scottish governments and the UK Parliament, so a very rich background from which to draw on. Here at Reform Scotland, one of our aims is to encourage our politicians and other policymakers to think more expansively and more creatively and to take greater risks. And we felt it was worthwhile taking a close look at the tax system, especially since the Scottish Government has been further fiscally empowered in recent years, to see what's being done, what isn't, and where there might be room for innovation. And we felt with our global perspective, it seemed sensible to ask Heather to do this, and also to have a look at how other countries of a similar size to Scotland go about their own business of taxation and balancing the system. The problems that we face, as everyone in this call knows, are legion at the moment. Inflation is driving a cost of living crisis with severe consequences for heating and shopping bills, mortgages and disposable income in general. Thanks to COVID, we're heavily indebted and public services require ever more sums just to play catch up or stand still. And thanks to Vladimir Putin, we're obviously spending vast sums on supporting Ukraine at the moment too. Of course, there are other areas of spending that are becoming ever more pressing as well, from tackling climate change to setting up a care system to making the most of the technological revolution's opportunities. And all of this is happening in the midst of a significant and frankly unhelpful demographic change. As Heather says in the report, it feels like tinkering around the edges just won't cut it. But neither should we doubt that the political and economic challenges of redesigning a tax system are significant. That said, we may soon have no choice but to do just that. We were pleased with the widespread newspaper and broadcast coverage of the report this week, which I think suggests there's a growing awareness that there is a problem and that we do have to talk about it in a grown-up and serious way. Luckily, we squeezed the launch in just before the First Minister unveiled her independence strategy, which kind of went off like a nuclear bomb in the media and left very little space for anything else. So we're going to start with a presentation by Heather of her findings, and then she and I will have a chat. And we're also very keen to take your questions, so please do use the chat gigo on your Zoom screen to send me any questions that you have, and we will get to them. So with that, Heather, I'll hand over to you for your exposition.
Great, thanks, Chris. Just to give you a sense of what's in the paper, the purpose of the paper was to provide a non-technical discussion of some of the big choices in tax policy and look at how the UK and Scotland within it compare internationally. It focuses on national level, not local level taxes. And that's purely because there's been a large number of previous reviews of local taxation in Scotland, even if the nettle hasn't yet been grasped around reform. It draws particularly on a number of Nordic countries and New Zealand. And the reason is because these are countries that have made big changes to their tax systems, but in quite different directions. So they provide a useful contrast when you're thinking about what the options might be for Scotland. So I'm just going to highlight 5 or 6 of the kind of key points or issues covered in the paper. The first is really the kind of key starting point for this was to say that Scottish governments are going to need to raise more revenue in coming years, irrespective of the constitutional situation. So we're all familiar with the fact that population ageing is putting more pressure on spending, health and social care, pensions in particular, and that we're going to need a lot of upfront investment for climate change, as Chris mentioned. But I think there has been less focus on how these and other shifts are going to impact our tax revenues, and actually are already, if you look at the Fiscal Commission's forecasts. We've got a couple of slides, and if it's possible, Ali, just to throw up slide 1, that would be great for people to look at while I'm talking. Oh, actually, but the only problem with doing that is okay, got it. So if we look at population, then in very simple terms, the amount of tax people pay, which is the red line, peaks in middle age, and at that time they are drawing the least on public services. And then you see take-up of public services accelerating in retirement, particularly over the age of mid-70s to 80, while the tax contribution drops away. At least that's what happens under the tax system as it's structured at the moment. So while the UK as a whole is ageing, this is not something that's unique to Scotland, but the trend is more advanced in Scotland. So we're looking at, over the next 25 years, a 68% growth in the 76 plus age group. So it's kind of worth looking on the chart at what that means. Almost no growth in the 30 to 60-year-old age group, and a 16% decline in the 16 to 30-year-old age group. And that interacts with economic performance. Labour market participation declines as we age. So even if we're talking about the working age population only, as more people in it are older, you get lower labour market participation. And that's actually the largest driver of Scotland's slower or poorer economic performance compared to the UK. Now, ageing, climate change and other trends will also erode tax revenues in a whole range of other ways. Just to give a few examples, ageing shifts demand to different kinds of goods and services, and some of the ones that will tend to have demand shifted towards them are zero rated in the UK VAT system, so you lose VAT. It changes savings and investment decisions. Older people tend to get more of their income from capital rather than employment, but capital is taxed less than employment income in the UK and Scotland. Decarbonisation, while it's something we really need to do, will reduce revenues from fuel duties and so on. We've already seen an increase in self-employment. Again, self-employment is more lightly taxed in the UK. And the increase in online shopping, a recent Scottish Government report said that this is, quote, struck right at the heart of the business rates tax base. So what we've been seeing over the last decade, as both the UK and Scottish governments have needed more revenue, is that they've tended to increase existing taxes rather than introduce new ones. And they've particularly increased taxes on income, and within income, it's particularly on wages. But tweaks aren't going to raise the amount of revenue that's needed just to maintain current service provision, never mind expand or extend it. And even if they could, more tax on wages is increasingly unfair, given, as I'll show you in a minute, the skyrocketing levels of wealth that we've seen in the last 30 years, and the fact that wages have stagnated and, of course, now are being further eroded with inflation. So the paper says we need a fundamental redesign, and that means two things: broadening existing taxes and taxing new things. The second key point, which is much shorter, is that there's no free lunch. So you hear a lot of calls to bring in tax breaks, either for existing devolved taxes or to devolve more taxes so that they can be cut in various ways. But unless you're going to slash services, a reduced contribution from one group will mean an increased contribution is needed from another. So I think people who are proposing tax reductions and reliefs need to be upfront about that and say who they think should take up that slack. The paper has quite a large section on cross-country comparisons, and I just thought I'd pick out one point from that just to kind of illustrate some of the types of things that it illuminates. And it's about why tax thresholds matter as much as tax rates. So people tend to focus on headline rates a lot and compare those, say, between Scotland and England, but equally important are the thresholds at which those rates kick in. The UK and Scotland's top personal tax rate of 45% is only applied to income above £150,000. That was 3.6 times the average wage in 2020. Now, by comparison, if you look at Sweden, they have a higher top rate, which is 52.3%, and it's applied to income above 1.1 times the average wage. So you pretty much get slightly above the average wage and you're into the top tax bands. It's the same in Denmark. And actually, it's not just the high tax Nordic countries that do this. New Zealand has a much lower rate of top rate of tax than the UK, but it applies it to income at 1.1 times the average wage as well. So these countries bring many more middle income earners into their top tax bracket than the UK or Scotland does. And that matters because it's not so much the rate that decides, well, the rate's important in determining how much revenue you get, but applying a wider base gives you more revenue. And if you have a flatter income distribution generally, then you're probably going to need higher rates to kick in at a lower level of income to generate the same amount of revenue. So the fourth big message of the paper is that it's the combined effect of all taxes and transfer that matters for the kinds of outcomes, economic progressivity that people are seeking. Effective tax design is not about trying to achieve every goal with every tax, so trying to make every tax progressive or every tax green. It's about having a tax system that is green or progressive overall. And the paper gives some examples to show that you can have taxes that are less progressive or even regressive, but are very efficient at raising revenue, which can then be redistributed and end up achieving more progressivity overall. So it's really important to keep your eye on and weigh up that whole picture. And that also matters for political economy reasons. So no one wants to pay more tax, or very few people anyway. Tax changes are always hard for governments. The losers shout much more loudly than the winners. The countries that have made big reforms have done so as a package. So when Norway and Sweden reduced their capital tax rates, they really broadened their base for capital taxation. They actually, even though they had a lower rate, they ended up raising more revenue than before, which they were then able to use to reduce labour taxes. New Zealand made big reductions in its personal income tax rates. It dropped the top marginal rate from 66 to 33%, and the corporate rate from 48 to 28%. That was largely financed by taking off tax concessions that mainly benefited higher income groups, such as for pension savings, and introducing a very broad-based VAT. So finally, the paper discusses three sort of big choices in tax design. And the first is how to tax different kinds of income. And if we just move to slide 2, this shows how different kinds of income is taxed in the UK, and I would sum it up as being a mess. The employed pay a higher rate of tax than the self-employed, who in turn pay a higher rate than people who incorporate and pay themselves dividends. And these different rates also mean that people with earnings pay more than people with income from capital. And people with income from different kinds of capital all face different rates, whether that income is interest or rental income from a second property or capital gains. So that creates a whole raft of unfairnesses, but it's also economically inefficient because it skews investments to less productive but lower taxed options like housing. So the paper looks at two models. New Zealand aims to align its tax rates across all types of income, whether it's from employment or from capital, to treat it all as neutrally as possible. And in contrast to that, a number of the Nordic countries moved to what they call a split rate system, where they apply a relatively high top tax rate to labour income, but have a much lower and a flat rate on capital income. Now, both of these models have pros and cons, and neither is perfectly applied, but they each reduce the distortions and inequities that are seen in the UK system, and take out the incentive to move, or very much reduce the incentive to move from employment to self-employment just for tax purposes. And they both do relatively well on revenue raising. So the Scottish Government's calling for more devolution of income taxes. And I think the question then is, well, what's the direction of travel that would be best for Scotland if that actually occurred? The second big choice, or recommendation, I guess, is to shift the burden of tax from employment to wealth. And again, it's for both fairness and economic performance reasons. So if we just move to the next slide, UK wealth has grown from 3 times GDP in the 70s to nearly 8 times GDP today. And yet the amount of tax collected on it has been almost flat. It's sat below 4% of GDP throughout that period. Much of that wealth increase has been passive or unearned, capital gains on housing, for example. And as we've just seen in the slide before, it's much less taxed than taxes on wages. So there's a nice illustration that the Resolution Foundation calculated. They looked at a person who inherits 1 million from their parents, they pay no tax. If you tried to earn that amount of money, and you were working at the national living wage for 40 hours a week, you would have to work from age 18 to age 70. you would still only earn 753,000, so only 3/4 of that amount, and you would pay almost 100,000 in tax, compared to 0 on the inheritance of 1 million. So in contrast to that lack of growth in wealth taxation, most tax increases have gone on to wages, and that's despite the fact that wages have been stagnating since the global financial crisis. They only got back to 2008 levels just before the pandemic. And as we'll see on the next slide, they're also, over the last 20 years, now being outpaced by growth in house prices. So there's a strong fairness case for taxing wealth more and wages less. And wealth is also more economically efficient to tax than either employment income or capital income. I think the key point here is not to look at these options in isolation. They need to be set beside the alternatives. So the UK Wealth Commission, and this is for the UK, did an estimate of what revenues you'd get if you had a one-off wealth tax applied to wealth over 500,000, or if you're in a couple, 1 million between you, at 1%, and only applying above that million level. That would raise 250 billion over 5 years. Now, to raise that amount of money through income tax, you would need to raise the basic rate from 20 to 29p, or you'd have to raise every income tax rate by 6p, or you'd have to raise every VAT rate by 6p. So the question isn't, is a wealth tax a good idea or not? The question is it a better idea than the reasonably realistic alternatives? The third sort of big choice discussed in the paper is about broadening tax bases. So it makes the argument that regardless of what is taxed, it's a good idea to broaden your tax base. So put simply, the broader base you have, the more revenue you will raise, either to use for spending or to be able to lower your rate overall for everybody. Lots of tax breaks means you need higher rates to raise the same amount of revenue. Someone has to pay for those tax breaks, all else being equal. It's a good idea to look at tax breaks because many are economically distortionary, they're often unfair, and many of them aren't even particularly effective at achieving their stated goals. So the classic example people always point to when I bring this up is VAT on food and kids' clothes, the 0 rating, as something that benefits poorer families, which it does, but it benefits richer families more. Richer families spend more money on kids' clothes than poor families do. And the Institute for Government has shown that if you applied VAT to food or other basic items, you'd reduce the incomes of the rich by more than the incomes of the poor. So it would be progressive in that sense. But the revenues that you raised would be enough to completely compensate the poorer half of the income distribution and still have money left over from the VAT paid by the richer half. And I think while people always point to food and kids' clothes and those kinds of exemptions, it's important to remember that many tax reliefs, including VAT exemptions, are not for necessities and are regressive. So there's VAT exemptions for private school fees, for domestic flights, for private healthcare, none of which lower income people are likely to be taking advantage of. So this is not to say that tax breaks are never a good idea. Every case and every context is different, but they do need to be carefully assessed. You have to weigh up the total cost, including for the people who are going to have to pay more tax to pay for them, to make up that lost revenue, and compare a tax break with other ways of achieving the goal. So just to sum up, the kind of key messages in the paper, I think, are we're going to need more revenue. One way to get it is to broaden existing tax bases. The other is to tax new things. And in doing that, we should be looking to shift the burden, particularly from employment to wealth. Don't start from the UK system. It's widely recognised, including in the UK, to be overly complex and highly distortionary. And as I think one of the quotes in my paper said, ripe for reform. Think about what's right for Scotland. And in doing that, it's really important to have a clear objective. So the countries that have achieved significant tax reform have been really clear about the model that they're trying to put in place and why they're putting that model in place. And they've been able to explain that to the public, what the change as a whole will achieve, and make the case for that. So I'll pause there and we'll see where Chris and others would like to take the conversation.
Thank you for that, Heather. That was absolutely fascinating. Always love a good graph. Just to say to everyone, please do send your questions in as they occur, and we'll get to them towards the end. Heather, I just wanted to start with probably a fairly obvious question, but how real is the challenge that we face economically at the moment, to the point that we have to actually rethink our tax system and redesign it in its entirety? Now, why is it not possible to just carry on as we are, tucking and trimming here, reassigning there? After all, we've stumbled on till now. So I guess the question is, what happens if we do nothing? And secondly to that, would you recommend, in terms of the change that you're suggesting, that it's a big bang or that it's a gradual change over a series of years or even decades?
On the do nothing, I think if you think back to that first graph that I put up, where you see what's happening with the over 70s and over 80s, and you see the working age population static or declining, you can see very vividly why doing nothing isn't an option. The Scottish Fiscal Commission forecasts the gap, if you like, in the money we'll need to cover social security in Scotland, which I think is an additional 760 million a year by 2025-26. They don't forecast what demographics are going to do to other types of spending in Scotland, but the UK does, and the Resolution Foundation has shown very clearly that even just to maintain existing services, tax revenue growth in the UK is not going to keep up or cover it. So something will have to be done, and Scotland's situation is more challenging demographically and economically. So I don't think the do nothing option, it has much mileage in it at this point. The big bang or gradual, I think it's not an either or. I think it's certainly true that the countries I've looked at both brought in quite dramatic tax reform and got, if you like, the big building blocks in place, but they also then chipped away at it over quite a long period of time. So New Zealand, for example, dropped those rates, got away with the biggest tax reliefs that were primarily helping the middle and upper classes, and brought in a VAT, a GST, but then over 20 years chipped away at some of the smaller reliefs and allowances that weren't so substantial, but each of which started to help get that greater alignment, greater efficiency, raise more revenue, and be able to further lower rates. So I think it's a bit of both, but I think they were able to do that because they had a clear idea of where they wanted to end up. Yeah, exactly. So it doesn't mean you have to do it all at once, but I think you have to be very clear about the model that you're trying to put in place and why you're putting it in place. You
do need a master plan in place before you begin, exactly. Even if you're a bit reactive over time, but you do need to know what it is you're heading for. One of the questions that's occurred, or statements that have been made in response to this paper, is it gives the sense that all in all, higher taxes are inevitable, because that in a way is what one might draw from the report. So are we talking about a new normal in which the floor is simply higher than we've been used to, even if we're paying tax in a different way and on slightly different things? If you change the tax system the way that you want, is it possible that the redesign can allow us to cover all of the new costs that we face, all the changes to our existing services and whatever modernisation, for paying roughly the same amount of tax in around, or are we entering an era of basically higher tax payments once you've accounted for everything?
So it's tricky, isn't it? Because when people say higher taxes, I think they are actually often thinking of income tax, or the ones that they know, and they're thinking of the headline rate. Yeah. So it would be perfectly possible to have lower tax rates, but with a broader base, for example. So I would say yes and no. The yes is, I think higher tax revenue is inevitable. We need to raise more money somehow, unless we're willing to make very dramatic cuts to social provision. And I don't sense in Scotland that's really part of the debate. But the question for me is, do you do that through hiking rates? And if you're Scotland, well, if you're any country, context really matters in all of this. How big you are, what proximity you have to a large neighbour, whether people can move easily, whether capital can move easily, all of that kind of stuff will affect actually how much tax you can raise before hitting problems of labour or capital flight. So that's one consideration. What I would say is that essentially countries, though, it's not determinative. So there are countries that are equally affluent, but achieve very different levels, and I've put this in the paper, achieve very different levels of redistribution. And there's countries that are equally poor and achieve very different levels of redistribution. So Italy raises about the same tax revenues as Finland as a proportion of GDP, but they only achieve 2/3 of the amount of redistribution that Finland does. So it's how you raise the money, yes, but it's also how you spend it that determines what your redistribution is overall. The thing I would say, though, is that the level of tax you raise is broadly associated with the model of social provision. So countries that raise the highest levels of tax revenue tend to have more universal social provision. Lower tax countries tend to target their social security more. Now, there's a bit of a chicken and egg here, I think. If we put it the other way, if you want to have more universalism, you're going to need to raise more tax revenue. If you can't raise more tax revenue, for a whole range of reasons, then you're going to need to more tightly target your social assistance if you want to hit on some of those redistributive goals and reducing inequalities goals.
Okay. Obviously, given the events of this week, we might have an independence referendum next year, or a slightly unhinged general election after that if the Supreme Court rules against the Scottish Government. But I wonder if you could touch on what could be done within the existing devolved settlement, because the Scottish Government does have power to introduce new taxes rather than just to tweak the system that it inherited. So what could be done within the existing devolved settlement, and what do you think the priorities should be?
Well, first, I'd be thinking about how to apply its existing powers to create new taxes. So it has a power to create new national level taxes with the agreement of the UK government that, as far as I'm aware, hasn't been tested. Although the criteria that the UK government would apply were set out in a 2010 command paper. And it has a power to create new local taxes. I'd be looking at that because if you have an aging population, you don't want to be overly reliant on employment taxation. So I'd be looking at things like land that are lightly taxed or not taxed at all in the UK, and that are immobile or relatively immobile. I'd include considering the scope for one-off windfall taxes. They're easier to administer and harder to avoid than other kinds of wealth taxes, particularly from sectors or companies that have made record profits during the pandemic. So I'm being a bit controversial here. But I saw some analysis the other day, it's not in the paper, that of the FTSE 350 that showed that the profit margins of the UK's top companies, so these are the big ones, were 73% higher in 2021 than they were in 2019, even though sales were down. So there's a question about one-off windfall taxes as an option to help fairly fund the COVID recovery. Second, and this is very consistent with my paper, I guess, is base broadening. Now, the Scottish Government doesn't have powers over reliefs and allowances for income tax, but they do over other devolved taxes. And I would be thinking very carefully about tax breaks, like tax breaks on business rates. They tend to be expensive and poorly targeted, and there's often cheaper and more effective ways of achieving their goals, helping business in this case. So just as an example, the current policy is to provide relief on non-domestic rates for the first 3 months of this year. It's 50%, and a couple of other bits and pieces. That will reduce tax revenue by 96 million. So that's what it costs. Now, coincidentally, that's almost the same amount as will be raised by freezing the higher rate threshold for income tax. That will raise 106 million. So you could argue that we are needing to raise 106 million from employees in order to support businesses to the tune of 96 million. Now, that might be a perfectly valid choice to make and an appropriate one. But I think we need to be really clear that if the government is foregoing revenues for one group, it is having to raise them from another. And more importantly, that this really is the most effective way to use 96 million to help business, and that there isn't a more effective way to do that. And then I guess finally, because the focus, I think, with the current, those are all other things, but the current devolved powers, people mainly focus on income tax, and it is the big one. I'd be thinking pretty carefully about where the higher tax rate sits and the top one, not just relative to the UK rate, which is what tends to get all the mileage, but relative to taxes on capital income. Because as the Scottish rate diverges, it does incentivize people to become self-employed or to incorporate and pay themselves dividends. And if they do the latter, that means that there's less tax revenue being overall, and what there is going to the UK government, not the Scottish government. People talk a lot about, tax flight, but actually all the evidence shows, and certainly in relation to wealth taxes, that people don't up sticks. That's not their first reaction to a kind of moderate tax. Their first reaction is avoidance or evasion. Well, their first reaction might be to pay it, but then they move into, is there any way I can reduce my tax liability and avoid or evade this? And only after that do they then think, right, let's uproot my entire family and move to another country for the sake of 1p. So I would be looking very carefully at that and thinking about how we can reduce the extent to which that's occurring. And then the other thing, and I raised this before, I think, is forming a view on where the top rate needs to sit. So there's been a lot of focus in Scotland about the higher rate, and I do understand that that's because it affects a lot of people. But the top rate only kicks in at 150,000, and given Scotland's much flatter income distribution, I think there would be a question about where, for this kind of income distribution, that sort of rate could or should kick in. Yeah, and then obviously there's a bunch of stuff potentially around further devolution and where you might look around that. But all the things I've mentioned, I think, are advisable or possible under existing settings, as far as I know.
Okay. One of the things I found really interesting in the paper was your discussion about the tax system in the round, so that it's less important whether any particular tax is progressive or even regressive. It's all about the efficiency and overall impact of the system. Now, we know, budget time and whatever, yes, of course, we look at the overall impact, but there tends to be a focus on whether this or that tax change is progressive or regressive. Absolutely. Which is, I don't know if that's a peculiarly British habit or that's what you get overseas as well. But I suppose it'd be interesting to just hear you a bit more on that, about how, the importance of the system and the importance of not being afraid to use a tax in a way that isn't necessarily hailed as being a wonderfully progressive way, if it's fitting into a system that achieves different things overall.
Sure. So to answer that question, I was hoping you might ask this. I'm going to just give one example, which I think kind of really illustrates it well. I should just say, when I say not every tax has to be progressive, look, I think in order to have widespread support for the tax system, it needs to be seen as fair. So there is a limit to the extent to which you might move in the other direction. But let me just illustrate this, and I popped a couple of slides across earlier. If we could just pull up slide 9, Ali, that would be really helpful. So I was going to use the approach that New Zealand takes to GST. Yeah, that's the one. GST, which is it's a goods and services tax. So it's basically VAT, just slightly different, to sort of illustrate this. So New Zealand has one of the most comprehensive consumption taxes in the world. So it has a headline rate, which applies to almost everything. And back when this graph was done, that's showing, the headline rate was 15%. Now that meant that in 2015, when this graph, the data is in this graph, it collected, because it was so comprehensive, it collected the highest level of revenues out of the entire OECD, despite the fact it had the 6th lowest rate. And if you look at the UK, at the time, it had a rate that was 5, I think it was 5, or was it 17 back then? It had a rate that was, 5 points higher at 20%. And yet it only collected 2/3 of the amount of revenue that New Zealand does. And now you might say, well, okay, but we don't like VAT because it's, it's regressive on income, yes. It's more debatable whether it's regressive on spending, but let's say it's regressive. But if you now turn to the next graph, this shows the difference in total tax and transfers combined that are paid by employees on the average wage, depending on whether they have children or not. And basically how long each line is tells you how big a difference the tax rate is for an average worker with children and an average worker without children. And what you can see is New Zealand has quite a big difference. So families with children end up paying much less. In fact, this was a few years ago, but it had one of the lowest rates at around a 5% tax rate when you weigh all the different transfers and everything up. Whereas the UK is one of the countries with the smallest difference between people who don't have children and people who do. Now, that's a policy choice, but it's a nice illustration of the fact that you can raise more revenue in one side of the equation, if you like, with VAT, but you can redistribute that. And in the end, it's the combined effect of all taxes and transfer that matters. So that's why I say it's the other thing I would say, actually, if we pop back on VAT, is that New Zealand raised a lot of revenue, but B, it was also able to have a lower rate overall. So the fact that everybody's you're only paying 15% on everything rather than 20% on some things also helps poor people too. So that's slightly more complicated than just saying we can somehow target the exact things that poor people mainly use and apply lower rates to them. There's a lot of work done by Resolution Foundation and others around these sorts of calculations, and they show that in nearly every case, it will be better to give direct cash benefits to poorer people or lower income, or however you want to define that, and apply flatter, more comprehensive tax rates.
I mean, just following on from that, in Scotland, there's been a long-term preference for universalism and public spending and benefits, whether that's university fees or prescriptions or whatever. Put simply, really, does that blanket approach work in an era as demanding as now, and in some of the changes you're thinking, would they lend themselves more to means-tested benefits, or do you think universalism can continue as it is while changing the tax system?
I haven't looked at individual areas of spending and kind of looked at how big that is and what that translates into in terms of the tax system. So I can't answer that specifically. But what I would say, and I don't think, I'm just trying to remember if I stuck the graph in the slide pack. Broadly speaking, it is definitely the case that the more universal provision, the higher levels of tax revenue you have to raise. But I can't really answer that if we just pick out some types, and not others. So, yeah.
Okay, fair enough. Last question from me just now, because there's a good sort of set of questions coming in. Just talking about wealth taxes as opposed to earned income. Whenever we talk about tax, especially with the word higher attached, there are warnings about capital flight, as you touched on, and you talk about immobile wealth in the report. Some argue that taxing wealth is unfair because you're taxing success and effort. And maybe there's a danger you move into the politics of envy and away from encouraging people to be successful in Scotland and stay here or come here in the first place. So how do you sell moving to a wealth tax situation, and what are the kind of, you mentioned land, but could you talk a bit more about the kind of taxes you would see working in that scenario?
Yeah. So one way in which I sell it is that comparison I made before about the treatment of somebody who inherits $1 million versus how long it would take somebody to work for their entire lifetime and not get anywhere near that and still be paying a large amount of tax. So there's a fairness issue. The other issue, and the OECD has come out very clearly and said this in a range of reports in 2018, 2019, that if you don't tax wealth itself, then wealth will accumulate if you're only taxing capital income. And that's because wealthy people have more money to invest. They are able to get higher rates of returns, partly because they can undertake riskier investments, partly because they have more access to financial advice, partly because of a lot of soft factors, like they know people and they can, be advised by peers who they have, all of that kind of stuff. So OECD set this out really clearly. And what they've said is, in the absence of wealth taxation, if already wealthy people are getting higher returns, then wealth will accumulate to the already wealthy. I think the fact that a large chunk of the increased gains, people say, oh, you're penalising success. I don't think that sitting in your house for 20 years is a form of success. I think you're getting an unearned capital gain by doing that. And I think it's worth noting that income from wealth, actually there's evidence in Norway too, that their wealth taxation has also helped improve income inequalities, which we're concerned about. So that's really interesting. Income from wealth is highly concentrated. So the top 10% of wealthy families in the UK receive 60% of financial investment income, and they receive 32% of rental income from housing. It's also more economically efficient. You know, if we're talking about what can we do for the Scottish economy, it's more economically efficient to tax wealth than capital income, and certainly more efficient than taxing employment. If you tax capital income, you put more burden on productive businesses that are generating a lot of income. If you tax wealth, you shift that burden onto the less productive ones who own something but aren't actually getting generating the profits from that. And it also has been shown to raise the savings rate of the productive ones. So if we use as one example, a wealth tax would tax land that isn't being used, whereas a capital income tax, you pay zero on that. So these are all reasons to think about not just taxing income from wealth, but the ownership of wealth itself. And just very briefly, you were sort of asking about which kind. I do think because of proximity and integration with the wider UK economy, it does need to focus on things that are less mobile and ideally are less likely taxed in the UK, at the UK level. I think, so that takes you to property and land, I think. At a minimum, there's strong arguments for replacing the land and building transaction tax with a more comprehensive land tax. No one supports, well, sorry, I shouldn't say this. No reputable international organisation thinks that transaction taxes like LBTT are a good idea. They're amongst the most distortive taxes. They're a tax on a change in a market that a willing buyer and a willing seller wants to make. And so they're particularly inefficient. They're recommended against by the OECD, by the European Commission. Merrill's back in the day, set out in great lengths why they're not a good idea. So I would be saying there's a strong case for replacing LBTT with some kind of more comprehensive land tax. Having said all of that, any kind of tax change requires a deep analysis of its implications in the context in which you're going to apply it. So this is not me recommending these things, but it would be recommending that these things are looked at.
Okay. Steve Halliday, you have got a linked question. I don't know if you feel it's been answered or whether you want to explore a bit further.
I think we'd just be a bit more specific, Chris. I mean, I think the big issue in Scotland is of attracting new businesses to set up here. And the language of wealth, how would you deal with this, Heather, of attracting wealth creators in to the country whilst taxing wealth, if you like, that's previously been created? I think the actual marketing of that is pretty challenging.
Sure. So I think on the whole, how do we attract wealth creators question? One thing I'd say is I don't think that tax is your main incentive or your main tool. Companies make their location decisions, or people, entrepreneurs, make their location decisions on a wide range of factors, of which tax is one, but by far not the only one and not the most important one. And I've referenced material in the paper, various evidence that shows that, provided your tax rate is not radically out of sync with your main competitors or drastically different, then actually if the competitive pillars of your economy are in place, then a slightly higher tax rate is not going to affect attracting businesses and people in. On the other hand, if those competitive pillars aren't in place, then you can cut your corporate tax rate all you like. You're not necessarily going to attract those businesses in. But the question I would ask, I'm not necessarily saying you don't have any incentives in your system. I am questioning whether doing it through the tax system is really a good idea. There isn't much evidence. The evidence internationally is very mixed around tax incentives to attract businesses. I could only find one study in Scotland, but please correct me if there's others, or a robust one anyway, which was the evaluation that Fraser of Allender did of the small business bonus scheme, I think it was called, which gave business rates relief to small businesses in Scotland. And I'm trying desperately to find the figure because I can't remember how much it cost, but it was a lot. Possibly somebody can scroll and find it. They could find no objective evidence that it had improved any business outcome. So my point is not that you don't try to attract businesses, but that you think very carefully about whether, and you gather evidence about whether headline tax rates are really the thing that motivates them.
No, that's fine. I mean, just the only thing I would say is that upper rate tax in Scotland, which makes a difference to people earning 40k and above, has just sends a terrible signal. It's actually not generated more money, but for a company attracting people in to go and do well, they're going to end up having to pay £1,000 more to that person to keep them equal compared to someone in Newcastle. So there you go. You don't need to come back on that, but Chris, you've got other questions to go to.
Sure.
Thanks, Steve. Ian McCartney. Ian, are you with us? You want to ask a question, Ian?
Sorry, I was muted. I was muted. Apologies. Thanks, Heather. It was really interesting, the paper you wrote, and I could understand most of it. And secondly, secondly, the way in which you set out the difficulties shone a really practical light in some of the issues that I'm dealing with at the moment as a voluntary member of a board doing health and social care. And my job is to represent the patients, the user of services. And that is in relation to the issue around the future of the care service, primary care service, including those who live in facilities either owned by the private sector, the voluntary sector, or increasingly less and less the public sector. Now, in this debate that's going on now, and legislation will come to Parliament soon, Scottish Parliament. But alongside that, there doesn't seem to be any plan of one, who pays, how much, and does the representatives, family representatives, make a contribution towards the cost of their loved one's care. And thirdly, there's an pressure on, say, from trade unions and others, that at the same time we nationalise the system. And that for me means poor care homeowners, absentee care homeowners, those who put their assets in the Virgin Islands and other places, will get a huge multi-million-pound handout for buying over probably inappropriate properties, land, etc. And I was wondering, what would you see in the move to a new system described by yourself, but the practical politics and changes in the system now can be dealt with in a way not to undermine what you would like to see in the long term, if that makes sense?
I'm not quite sure that that is ground that my paper has particularly covered. Chris, do you want to, is there a sort of a framing that you think might be helpful?
Well, I suppose one of the big areas that we know is coming down the line is a care service, a national care, so it's going to be a huge outlay. I don't really think any of the political parties have priced this properly yet. I think the manifestos were pretty woeful on it. They've all got a plan, but none of them have got a realistic costing. But inevitably, if we moved to a new tax system, one of the reasons for doing it would be things like this that haven't necessarily existed in the way we'd like them to exist. So I don't know. Is there a specific thing that Heather could answer, Ian? That
it's just a dilemma that people have got in the short term to moving from the system we've got now to a new system, and whether that new system simply carries on with the inappropriate levels of funding we've got, or do the politicians get the capacity to then actually, before that, put forward a new set of proposals in terms of how the system will work and how effectively it will work?
Well, I don't think maybe that's quite Heather's area, I'm getting the impression. So we could maybe have a talk about that, Ian, a bit more offline, if that's all right.
Yes, fine.
It is an area we're keen to look at. In fact, we are looking at it as a think tank. So let's come back to that. Mark Drayton. Who's with us, Mark? Are you there, Mark?
Yes,
Yep,
I am here. Unfortunately, I haven't got my question in front of me. I don't know how this is going to work. Is there any chance you could read it?
Let's see. So you say you have been seriously concerned about intergenerational inequities. Does Heather agree that our economic system currently depends on the widespread ignorance of our young people as to their predicament, and that this situation is not merely unfair but also highly dangerous?
Yes. So I, had to skim over lightly in the presentation, but certainly I've made the point in this paper that the sort of inequalities that are being generated by this, particularly with wealth accumulation, are really exacerbating intergenerational inequalities. There's also some evidence around race-related inequalities in the UK as well, being exacerbated by this increasing concentration of wealth and erosion of wages. So yes, would be the short answer.
Esther Robertson. Are you there, Esther?
Sorry, it wouldn't let me unmute, Chris. Apologies for that.
No problem.
You'll have seen I put a few comments in the chat, but in a way I think Heather's probably answered the one I most wanted to ask, which was the one about wealth taxes. Because I think the notion that the wealth tax is a tax rather than a range of approaches to different things. And I also wanted to make the point that I absolutely got the chap's comment about attracting individual talent, but the focus on wealth creation, I think, needs to be much more local and move us away from the notion of having to bring it in. And the final point I made just in the chat there, just for the former questioner there, is thankfully, as far as I'm aware, no party is proposing that we should go and buy out all the private care providers. That would be something ludicrously expensive. But since you gave me the floor, just to say thank you to you and to Heather. It's been a phenomenal paper and a great discussion. And I think somebody made the point, expressed in language that everybody can understand, and we need to get this debate out there much more widely. And be clear about purpose, which was the first point you made, Heather, and I think that's critical.
Yeah, and if I can just add, one reason why I looked at a comprehensive wealth tax rather than all the different types of wealth that you can tax was partly just about time and space, because we were looking at other things as well. But partly because I think, in principle, it shouldn't matter where somebody puts, what form people hold their wealth, right? You would want to tax that all evenly. The problems are generally more practical, that some kinds of wealth, like, art and jewelry, are much more mobile. And also you do get into problems of valuation in order to do a wealth tax. So that then takes you to things that can be more easily valued and are less mobile, which is where you end up at property and land. But I think that if you start with the principle that we should be comprehensive taxing all wealth, you can then work back from that, or perhaps what you're doing is working towards it in terms of building the systems required. It's worth saying that there are only 4 countries that do comprehensive wealth taxes at the moment, but there are 4, and a number of them do it at both national and subnational level. And I've referenced that in the paper because I thought that would be of interest to folk in Scotland. But although there was kind of a general move away from wealth taxes 10, 15 years ago, I think with the work of Thomas Piketty, I think with the sorts of wealth inequalities that have widened up following the global financial crisis and now more recently COVID, there's definitely renewed international interest, huge reports from the OECD even before the pandemic. And I referenced in the paper at least 3 Nordic countries who have been increasing or introducing new wealth taxes in the last couple of years. So I think this is a debate whose time has definitely come.
I could absolutely agree, and you've triggered, if I could be rude and pick up a supplementary. I only found out about the event yesterday, so I haven't managed to read your paper yet. Are there any other countries, because you've already referenced one of the biggest issues in the wealth area is our hugely inflationary house prices. And I read an article yesterday about someone who bought his council house and is now sitting on something worth 1.4 million. And he's not earned a penny of that. Do other countries have that same kind of house price issue, or are we unusual in that here?
I feel desperately keen to invite Des McNulty into the discussion because he knows about this in massively more depth than I do. And what I can say is that I'm sitting in the country that has had the most extreme house price inflation in the OECD, as far as I know. So it's way worse here. But yes, it has been, it's happening in a lot of different places.
Thank you.
Okay, right. We're going to try and squeeze in 3 questions before we end, and it's the 3 people with their hands up. We'll start with Graham McCormick, then we'll go to Des McNulty, then we'll go to Alistair Milne, hopefully. So if you can keep your questions relatively short, and Heather, I know it's a lot to ask, but if you can keep your answers relatively short. But we'll start with...
You know me too well.
I do. Graham McCormick.
Thank you very much. My apologies, I'm going to have to go in a minute or two. I've got another meeting to attend. But I've written a book on an annual ground floor and roof rent, which has the capacity to replace all other taxes and raise far more money. Now we're in a position where, people are going to be faced with huge hardship in the next few months and years. And this has the capacity to actually create enough money so that everyone could have a universal citizen's income of about £200 a week, which would really transform lives. We're in a position of emergency. It's simple to bring in. You can actually bring it in under Section 80I of the Scotland Act. So it could actually be brought in by the Scottish Government. Under that, it would replace the land and building transaction tax. It would allow income tax and earned income to be reduced to 0 in Scotland. And it would also abolish rates and council tax. And I really think it is something which should be considered. I've debated it with Kate Forbes. She didn't knock it out of hand by any manner of means. And I really think it is something that should be really seriously considered. It's all ready to put in place. All we need is the legislation. You don't even need a completed land register to do it, because you put the obligation on the owners of property to actually register for it. And if they fail to register for it within 2 years, the Scottish Government has the power to repossess it.
I don't think I need that. Sounds very interesting. I'd love to read it. The one thing I will say is I threw in a few just sort of slightly more left field ideas in the paper as well that people might be interested in. So one was, for example, a recent New Zealand government commissioned independent review, but we're throwing ideas out there like having a land tax where rates depend on the intensity of use of the land and its impact on the environment, for example. So, you can combine some of these things to help achieve some of your wider goals as well.
Okay, Des.
Thanks very much, and great paper, Heather, of course. 2 points really. One was, should we be looking at this narrowly in the context of Scotland, or should we be looking at it in the context of the UK? Because it seems to me that actually many of the things that Heather is putting forward, are necessary at UK level, and it would be better for Scotland if they were introduced at the UK level. I mean, obviously political challenges in that, but I don't think it should stop us campaigning for some of these changes in a UK context as part of a radical change agenda in terms of constitutional change, in terms of economic management. And I think that the whole set of ideas, the complex of ideas, and actually looking at it in a radical way is a really important aspect of kind of responding to the current crisis. The second point, the second question, really, I mean, I worked with Heather before on issues about how you move towards better targeting of support for vulnerable groups. And one of the issues in Scotland is that we've got a lot of totemic universalistic policies, and arguably, we'd be more effective if we actually had more targeted interventions, whether that's in terms of support for higher education or support for care or support for other types of vulnerable groups. Is the argument that you're putting forward about taxation, run the risk of avoiding having the debate about universal versus targeted support in the way in which services are provided? Or could we run these two together and actually argue for both at the same time, which I think is certainly my position?
Yeah, I think you have to. I think they're so completely intertwined and interdependent. The choice of model determines how much tax you need to raise, but there are also constraints on how much tax you can raise, given your circumstances, whole range of different things. that will then inform the kind of model that you can adopt. So I think they have to be interdependent. The other thing is, I gave you sort of mentioned about kind of political saleability, I guess, in radical reform. I gave a couple of examples where the countries I've looked at very much made reforms as part of a package. And I just sort of thought it's worth mentioning on the wealth side that the OECD, who, you know, are a fairly mainstream body, actually recommended that countries look at wealth taxation as a fair way to pay for the COVID recovery, but combine it with reductions in labour taxes, so that a tax that's going to affect a smaller number of people, a wealth tax, is set side by side with something that will benefit a large number of people, i.e. wage earners. So I think, you know, these are the kinds of ideas, and as I would agree with you that some of these sensibly can only be discussed in combination with UK colleagues.
Okay, thank you. And then last question, we're just over the hour, but we'll come to Alistair Milne to round things off.
Thank you. Just very quickly, I'm concerned very much about the entrepreneurial activity. And I think I'd like to make one point that you raised was that taxation, lowering corporation tax effectively didn't enhance the amount of activity that goes on. I think that's yes and no in a sense. You can see the example, of course, is Ireland that invested, brought it down and had a huge amount of investment. The Irish situation is obviously different from Scotland. But I agree with you that the early stage companies, entrepreneurial activity, taxation is the last thing you're thinking about. But I wouldn't want the taxation, capital taxation, to be something that was counter to people actually getting involved in entrepreneurial activity. And in your talk, you seem to indicate you were talking all the time about unearned capital in a sense. And is it possible to have a difference between sort of unearned capital, like a house, which you don't do anything about, just happens to go up because there's basically a fixed number of fixed space that we've got houses on, whereas earned capital, where you're actually, it's as a result of entrepreneurial activity, has a sort of different aspect to it, and I wouldn't want that to be sort of pressures against doing that type of thing. Yeah.
The short answer is sure, you can, and some of those distinctions in the UK tax codes are attempts to do that. They will all lead to people moving money around to try to reduce their tax liability. That's what rational people do. On the corporate tax, just a couple of comments. One is, obviously, we now have increasing moves globally, and that started to introduce a floor. So I think the idea of a 15% floor for the large multinationals. So the idea that we can sort of engage in a race to the bottom to be more competitive on the corporate side, I think, is no longer really. Yeah, and look, the Northern Ireland Assembly just or commissioned or the Fiscal Commissioner, sorry, can't remember exactly which their name is, but they basically just produced a report on options for further tax devolution to Northern Ireland. And for them, this is particularly pertinent because obviously they share an island with the Republic of Ireland and its lower corporate tax rate. They are concluding that they might want corporation tax devolved, but really the kind of idea that you can lower it now is increasingly international, or, you know, lower it by significant amount is increasingly internationally unacceptable. And their assessment is it's doubtful that that would actually improve their competitiveness to any significant degree. So, I'm not saying don't try to attract entrepreneurs. I'm just saying have quite a rigorous process for working out whether tax breaks, which are enormously expensive, are actually the most effective way to do that.
I would argue that it's an expense of something that didn't exist previously. Therefore, it's you can't really design it. You can't really talk about it.
Well, it's a hole that someone else has to fill.
So wealth creation is what we need in Scotland.
Well, listen, thank you, Heather, for your time. I guess it's now 10:05 where you are. Time for some cocoa in bed. It's a wonderful report, and we're delighted that Heather's an associate of Reform Scotland, and we have a brilliant relationship with her. I think she's an outstanding researcher, and all the work she's done for us has been absolutely A-grade. So very grateful to that. Thank you to you all for joining us today and for your questions. You know where we are if you want to speak to us any further. And we're always open to your ideas and to just having a general blether about the state of things. So keep in touch, and we shall see you soon, I hope.
Thank you very much.
Thank you.